Hello, this is Brad Harvey. Welcome to our Ask the Advisor video series, where we answer your financial questions. Hello, today's question that we're going to answer is timing the market or trying to time the market a good idea? Well, I'm here to tell you I've been doing this for over 25 years, and timing the market is an elusive goal. Many people think, well, the markets are very high right now. And they are, and many people think the markets are very low right now, and they are. Those are subjective measures. The problem with trying to time the market is you never know really when the top is or really when the bottom is until after they've happened. Now, there are many different valuation metrics that we can use, and we can talk about momentum, and we can talk about earnings and price to earnings multiples and GDP growth levels and all of these other factors. None of them have turned out to be 100% accurate. But I will tell you that over time, the right investment strategy has been to have good exposure and keep that over the long term, rather than trying to time the market. Keep in mind the old adage of buy low, sell high. That's the 2 points that are important: the day you purchase a security and the day you sell it. What happens in between, quite frankly, is not relevant, although it can create an emotional or psychological roller coaster. So remember, when you're looking at whether or not you want to time the market, it really is more a function of risk management, comfort level, your goals, and your asset allocation. What is asset allocation? To review, it is simply the long-term percentages in your overall investment portfolio that you have in different investment asset classes. What are asset classes? Like real estate, stocks, U.S. stocks, foreign stocks, small, medium, large, bonds, government bonds, corporate bonds, short, intermediate, and long term, commodities, things that come out of the ground, like precious metals, gold, silver, platinum, palladium, copper, or oil and gas, or agricultural products like wheat and corn. So those are the different asset classes. And when you sit down and work out your goals and say, okay, perhaps I want to have 60% exposure in stocks, for example, and 40% exposure in commodities and fixed income. Okay, that's fine. And then let's say 12 months later, the market's done really well. And instead of 60% exposure, it's actually 70. Well, it might be prudent to go ahead and trim that back or rebalance the portfolio back to your original allocation goals, which would be 60%. That actually helps to reduce risk over time. Now, it can also dampen returns. Remember, risk and returns typically go together. However, that is the smart play. So from a timing perspective, that is far more objective. Yes, I would like to keep 60% exposure in the markets, and I'm not going to rebalance more often than annually, or I'm only going to let it go up to 70%, and so on and so on and so on. And as you get closer and closer to your goals, perhaps you want to adjust those allocation percentages, but that is not necessarily related to market timing. So the question that we answered today was, should I be trying to time the market in my investment portfolio? Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, please send us an email to harvey@r